And they have the technical dynamics also of breaking out on the spread chart, favoring the miners versus gold. So yes, I would argue at this point, watch gold, but preference the miners. And if you don't want to pick them out, just do an ETF or buy a basket. The gold miners should do much better than gold. Not as good as silver, but much better than gold. As issue of oil, it's a falsehood. We ran a study on that a couple of months ago showing periods of time where gold miners and oil moved, and you can see just the price chart comparison. My view of the 60-70 range is gone. I no longer have that view. I now think you could go to 100 to 200 in the next couple quarters. We've done a lot of technical rationale for that. It's not just a gut feeling, okay? But we've shown that if you look at silver on a chart, just an arithmetic chart, go back to 1975 when gold was legalized. Gold has had huge surge up, then a pullback and a range for a decade. Then another huge surge up and a new higher range for a decade plus. And now is into another surge, which is, by the way, only half as strong so far, measured logarithmic scale, ratio scale, to the prior two bull markets. If gold matched them, it'd be $8,500. Okay, but how come silver is stuck in this box for 50 years? We showed charts of copper and lead. Okay, real exciting stuff, lead, But in the 70s, 80s, 90s, and into 2000, they were stuck in a range, sort of like silver is now still stuck in. And in 2005 and 6, copper quadrupled in about a couple quarters. It just left that old reality behind. And then over the subsequent decades, a new range that if you divide the middle of that range it's been living in for the last 15 years or so, it's 4 times what it was between 1970 and 2005. Okay. How come silver's still stuck in that range? Then we look at lead, and lead had the same situation for multiple decades, caught it at a price range, blew out of it in 2007, not in sync with copper on its own stuff, quadrupled in price in a matter of a couple quarters, and then lived in a new reality, way above that old reality. How come silver's here? Well, there's some arguments that are likely valid that, it's been artificially depressed, suppressed, etc. But whatever the reason, you can't fake reality forever. And if gold, the other monetary metal, has gone from, a peak in 1975 at 200, then in 1980 was 850, and now we're 4,000, and yet silver in 1980 was 50, and we're at 48. Okay, now something's wrong there. Forget any intricacies of special situations. What's going on? I mean, lead's 4 times its price then. Copper is silver, anyway, there's a point to be made there. Sometimes markets make mistakes. We know that. As an investor, if you're around long enough, you've seen bubble markets make a peak. And when it falls apart, you look back and say, oh, golly, now I can see why. It was irrational, too high for too long. Even if the concept underlying it was valid, it just went too far. And the same thing goes on the downside. Markets make mistakes on the downside. They get down too low. They lay there. Nobody likes them. They're not doing anything good. So who's going to invest in them? And then when they wake up in a thunderbolt. The technicals of silver right now argue to us. Now we've got one trigger level that we'll talk about in a minute. That when it's triggered, we think over the following 2 quarters or so, in other words, 6 months or so, silver could go to at least 100, more likely to 150 to 200. In other words, you could quadruple its price in a matter of a couple quarters, doing the same thing that's been done in many other markets over the past 50 years, here, there, so forth. And the technicals justify assuming that. It's not just gut feel, okay? And anyway, that's what we see. So the 60-70, forget it. No, we don't believe that. Much higher.
When gold was legalized in the US, it crashed first, then rocketed 8 times higher within 4 years. In 2001, it repeated the pattern again, bottoming near $260 before rising to $1,020 over a decade. Today, gold has already begun another powerful launch, outperforming most global stock markets and signaling a new wealth rotation. Meanwhile, silver has not yet joined the move, a rare divergence between the two monetary metals. Based on gold's historical trajectory, analysts argue that silver has significant catching up to do, and its reversion could happen explosively, not gradually.
My own personal investments, which I have to disclaim at the end of all our reports, is what do I own? Okay. I'm wholly emphasizing silver and silver related. And I think some of the miners might be as much bang for the buck, if not a lot more, than what silver might do. And the reason is they're still very lagged to the gold miners historically. They're very lagged to almost any way you want to measure it, to gold. Or the silver miners are the real dogs. The gold miners have gone up, and notice GDX, for example, had a high in 2011 in the 60s. Well, it went up to $80. Okay, pullback, and right now we're like 68 or 70. I think we're 70 area. Okay, so it had a pullback, but it burst through this at like a doubling in price in a matter of a handful of months, just to get above the 2011 high, which, as we know, gold's way above that. It was $1,920. Okay, so the gold miners said, I'm here too. I'm back. Okay. The silver miners aren't above that high. For SIL, for example, that high in 2011 was at 90. And we didn't get there. I think we're going to get there and then some. I think it's, again, sort of the phenomenon. I'm talking about what I think silver is going to do technically. The silver miners perhaps should best be viewed not as miner by miner by miner analysis, but more as, hey, they got the stuff underground and it's not priced at even the per ounce level. Okay, you're in effect buying silver bullion at 10 cents on the dollar, okay, by buying the mines. And I think that acknowledgement will come when silver runs its tantrum move. It goes to the new reality. And I think at that point, you want to be long silver. Perhaps if you want to, silver calls that go out a year, let's say, and the silver miners, as opposed to gold and the gold miners, which will also be going up, but less so. So I think it's the focus now should be on the silver component of the monetary metals.
And I know you don't discuss stock picks or anything like that in your newsletter, but when you're approaching the silver mining space, do you look more to the ETFs as the way to play silver miners, or do you venture into individual mining stocks as well?
I've gone into a handful of individuals, but basically I think the thing, rather than being specific and relying on some analyst's analysis of this miner or that miner, this one's a dog, that one's good, I think you could throw darts. I think the whole pack of them is going to go up because the power that will drive them isn't going to be what's the profitability of this company versus that.
Right.
It's basically, my God, an underpriced category, and money will just flow into it. And even garbage stocks will go up. Okay, you get my point.
Yeah.
That's the kind of phenomenon I'm talking about.
Investors know bubbles exaggerate to the upside, but they forget that underpriced assets also go too low and stay there until no one is paying attention. That creates the perfect setup for a thunderbolt revaluation. Silver's sideways pattern looks identical to setups that launched copper in 2006 and lead in 2007, both quadrupling in months. History shows deeply neglected commodities always snap violently into a new reality when supply tightens and capital floods in. Silver's technical indicators now flash the same signals, a dormant giant waking up. When it breaks out, price inertia flips from painful stagnation to unstoppable momentum.
I think the pullback you just saw is a buying opportunity. Again, when you put it in perspective of what has gold done since the government legalized it. Well, it had a bear market low in 1976 after hitting 200, and when it was legalized, it dropped to $103, mid 76. Between mid 76 and 1980, 3.5 years, it went up eightfold. And the conditions that drove that, we argue, are far less dynamic than the ones we're sitting on right now. Okay, two. The next bull market started in 2001 from a $260 low and went to 1920. Eightfold move. Spanned 10 years, but an eightfold move. Okay, we're only fourfold off the bear low, $1,050 in 2015. So people say, oh, it's overdone, it's overdone. There's another argument that it's just beginning. And it's the first charts I sent you. The first chart shows a spread relationship between an ounce of gold and the price of the S&P 500. And it goes back to 2013. Remember, gold peaked at 11. In 2011, 12, 13 especially, it's entered a bear market, which didn't bottom until 2015, okay, end of that year. During that time, it was underperforming the S&P 500. The spread was collapsing along with the net price of gold. But then, in the 11 years since that, during an 11-year period of that basing process, there have been 4 rally highs in the spread, meaning gold has had a rally versus the S&P relative performance-wise. And each of those rallies, by the way, was actually strong upside in gold, net price. But there's a clear base that a kid with a crayon could draw a line across. 4 separate peaks that are almost flat. You're pushing at that line now again. Right now, the spread between gold and the S&P is 58.6%.
Technical analysts have identified a key breakout line that could completely change silver's price structure. Once breached, models suggest silver could race to 100 as or 200. If silver explodes higher, mining companies may deliver even bigger percentage gains. Gold miners have already doubled from their decade lows, but silver miners still. Gold has already broken out against most major equity indices. Only the S&P 500, inflated by a tiny handful of megatech stocks, masks the turning tide.